YouTube family, the 2% rule isn't protecting you, it's limiting you. Most of you are following this blindly without fully understanding what risk management actually means. Let's dive deep. I'm about to tell you something that is contrary to most beliefs. For 2.5 years, I religiously followed this rule, risking exactly 2% on every single trade I took, regardless of setup quality, market conditions, or my confidence. And you know what happened? I stayed consistently mediocre. I remember having an incredible EURUSD trade back in March 2022. Everything was aligning perfectly. I had a clear trend, a perfect retracement to my fib level, and textbook price action confirming my entry. My confidence was through the roof, but I risked my usual 2%. Why? Because every guru told me to do this previously. That trade moved 400 pips in my favor over 3 days. With 2% risk, I was able to make 6% profit. Solid, right? Wrong. The following week, I took a mediocre setup. The trend was unclear, mixed signals, and no major confluence, but I still risked 2% because that's what disciplined traders do. That trade stopped me out immediately. That's when it hit me. I was treating a slam dunk setup exactly the same as a questionable one. I was risking the same amount on my A+ trades as I was on my low confluence trades. I was following a rule instead of using my brain. The 2% rule wasn't protecting me. It was preventing me from capitalizing on my best opportunities while failing to protect me from my worst ones. If you've ever felt frustrated that your amazing setups don't seem to make you much money, or you've wondered why professionals don't seem to follow the same 2% rule they teach retail traders, this video is going to open your eyes up to what risk management really means. Now, here's what's really happening when you follow the 2% rule and why this oversimplified approach is keeping you from big trading days. The 2% rule was designed for traders who do not have the ability to distinguish between high probability setups and low probability setups. It's training wheels for traders who cannot evaluate trade quality, market conditions, or their own edge. Here's your problem. If you're still using training wheels after years of trading, you're not developing the skills you need to become truly profitable. Let's think about this logically. Professional poker players don't bet the same amount on each hand regardless of their cards, right? Yet somehow retail traders have been convinced that risking the same percentage on each trade that they take is proper risk management. It doesn't add up. The 2% rule makes several dangerous assumptions. First, it assumes that all your trades have equal probability of success, but experienced traders know this isn't true. Your best setups may have a 70% win rate, while your marginal setups may have a 40% win rate. Why would you risk the same amount on both? Second, it ignores market volatility. A 2% risk in a low volatility environment might give you a tight stop loss with a good risk to reward ratio. The same 2% risk in a high volatility environment might force you to use a stop loss so wide that your risk to reward ratio becomes terrible, or a stop loss so tight that you simply get stopped out through market manipulation. Here's the most damaging aspect. The 2% rule trains you to think like a robot instead of a trader. It removes the need to evaluate trade quality, market conditions, or even your own confidence level. You just plug in your 2% risk and take the trade. This mechanical approach prevents you from developing the judgment and intuition that separate professional traders from automated systems. Real risk management isn't about following a fixed percentage. It's about understanding probability, evaluating opportunity, and adjusting your exposure based on your edge. The most successful traders risk more on their high conviction trades and less on their marginal setups. They understand that risk is dynamic, not static. Let me break down my advanced risk management framework that you can use. The first is dynamic position sizing based on setup quality. Instead of risking the same percentage on every trade, develop a tiered approach based on setup quality. Your A+ setups, those with multiple confluence and clear trend direction, should get 4 to 5% risk. Your B+ setups, good but not perfect confluence, should get the minimum of a 2% risk. And those confluences that barely meet your criteria should be skipped entirely. This approach ensures that you're capitalizing fully on your best opportunities while limiting your exposure to marginal trades. Over time, this dramatically improves your risk-adjusted returns because you're putting more capital behind your highest probability trades. The second tip is market phase position sizing. Different market conditions require different risk approaches. During clear trending markets with obvious direction, you can afford to be more aggressive because your edge is higher. During choppy, uncertain markets, you want to reduce your position size dramatically or even think about stepping aside completely. I classify the markets into 3 different phases. Trending, I'm going to have bigger position sizes. Retracing, I'm going to have moderate position sizes. And ranging, I'm going to have minimal position sizes. This adaptive approach keeps me aligned with the current market conditions. The third tip is confidence-based sizing. Now, this might be controversial, but your subjective confidence level should influence your position sizing. I don't use gut feelings or emotions. I go off of educated confidence based on analysis quality, setup clarity, and the market conditions. When everything aligns perfectly and you have a high conviction, that deserves more risk than when you're taking a trade because you're bored. Develop a simple confidence scale, 1 through 10, where 10 is maximum conviction and 1 is minimal. Never take a trade below a 6. Risk standard amounts on setups with average confirmations and consider going with higher amounts of risk when your conviction is high. My fourth tip is time-based risk adjustments. Your risk tolerance should also adjust based on your recent performance and your psychological state. After a string of losses, you want to consider reducing your position sizing to rebuild your confidence and avoid revenge trading. After a period of strong performance, you might increase your position sizes slightly, but be careful, do not start to get overconfident. This isn't about changing your strategy based on emotions. It's about recognizing that your psychological state affects your decision-making ability and adjusting your risk accordingly. Let me share the exact trade which proved to me the 2% rule was destroying my potential, and how abandoning it led to my biggest breakthrough in trading profitability. This trade was back in September 2021. I had been following the 2% rule religiously, and I considered myself disciplined because I never varied from this percentage no matter what. Then came a setup that changed everything. A once-in-a-year USD JPY opportunity. The Bank of Japan had just intervened to weaken the yen, creating massive volatility. My technical analysis was screaming bullish. We had just broken out from a 6-month consolidation. Multiple timeframes were in alignment, and the fundamental analysis supported a continued yen weakness. My conviction on this trade was absolute. This was as close to a guaranteed winner as trading gets, but I still risked my 2%. Just as I predicted, this trade moved 800 pips in over 2 weeks, but my profit, a measly 5.2%, because I was still thinking like a robot instead of a trader. Meanwhile, I watched traders post 15 to 25% gains on the exact same move because they understood how to size positions based on opportunity quality. The very next month, I took a mediocre GBP USD setup. Mixed signals, unclear trend, and no major catalyst, but I still risked 2% because discipline. That trade stopped me out immediately for a 2% loss. That's when I realized the absurdity. I was treating the best setup of the year exactly the same as a random Tuesday trade that barely met my criteria. That night, I threw out the 2% rule forever. That's when I developed my tiered risk approach. Standard 2% for B grade setups and 4 to 5% for A plus setups where everything aligns. I also started factoring in news events, correlation, and the market conditions. Instead of grinding out 3 to 5% monthly gains with the occasional loss, I started seeing 10 to 15% months when high quality opportunities presented themselves. Balanced out with the 1 to 3% months when I was waiting patiently for the right setup to appear. But here's what really changed. I stopped getting frustrated with my best trades. After nailing a perfect analysis and a trade playing out exactly as I predicted, I was finally getting paid proportionally for that accuracy. My biggest winners started making up for multiple small losses instead of barely moving the needle. The most successful traders don't follow the 2% rule. They follow probability-based risk management. They understand risk management isn't about limiting yourself with arbitrary rules. It's about optimizing your returns based on opportunity quality and market conditions. The 2% rule was designed for traders who cannot think for themselves. It's a safety net for those who haven't developed the skills to evaluate trade quality or market conditions. If you've been trading more than a year and you still can't distinguish between your best setups and your worst ones, your problem isn't your risk percentage, it's your analytical abilities. Real risk management is about understanding your edge and betting accordingly. When you have a massive edge, you bet more. When your edge is questionable, you bet less or you don't bet at all. When your market conditions are perfect for your strategy, you increase your exposure. When the market conditions aren't good, step aside. The 2% rule teaches you to think like an amateur who treats every trade the same. Professional risk management teaches you to think like an investor who allocates capital based on opportunity and probability. Your biggest winners should be making you significantly more money than your biggest losers are costing you in trading. If they're not, then you're not managing risk, you're managing mediocrity. And mediocrity in trading doesn't just limit your profits, it limits your potential to ever achieve financial freedom through trading. Understanding these gems was the key for me to taking the training wheels off and maximizing my risk allocation when the market presented quality opportunities and the right market conditions. Let me know in the comments how you took your training wheels off when it comes to managing risk accordingly. And there you have it, YouTube family. Another video wrapped up for you. If you found this video useful, you know what to do. Hit that like button, subscribe to the channel. You know I'm going to always give you the game. If you want access to my free community as well, the link is in the description. Let me know what videos you guys want next. Hopefully I'll see you guys soon. Peace. Thank you for watching the latest episode. If you like that, please like and subscribe to my YouTube channel for more content. I'll see you on the next video.